Do you feel like no matter how hard you try to save, your money keeps slipping away? Personal finance is tricky, and it's easy to make mistakes that cost you money in the long run. Whether it's ignoring inflation, not budgeting properly, or getting caught up in social pressure, these mistakes can seriously hinder your ability to build wealth. In this video, we're going to uncover 8 personal finance mistakes that could be draining your wallet without you even realizing it. These are mistakes that people often overlook, but once addressed, can make a huge difference in your financial future. Let's dive into these mistakes and learn how to avoid them. 1. Treating inflation as a temporary inconvenience. Inflation is often treated as a temporary issue that will eventually resolve itself. However, this misconception can be one of the most damaging to your financial future. The reality is that inflation is a structural issue, not a passing inconvenience. Rising prices steadily erode the purchasing power of cash that is just sitting in your bank account. If you're waiting for prices to return to normal before making investment decisions, you're doing yourself a disservice. Failing to factor inflation into your long-term financial plan leads to significant shortfalls, particularly in retirement savings. For example, if you're saving a fixed amount of money and it isn't keeping pace with inflation, your future purchasing power will be much lower than you expect. What seems like enough money today will not be enough in the future, especially with rising living costs. To avoid this mistake, it's essential to invest your money in ways that outpace inflation, such as stocks, real estate, or other inflation hedging investments. Keeping your money in low-interest savings accounts or relying solely on cash for the long term is one of the biggest financial pitfalls. By investing wisely and factoring inflation into your projections, you can protect your wealth and ensure that it grows over time. 2. Splitting bills with unequal spenders. Social situations often create financial challenges that are hard to navigate. One such situation is when you split bills with friends or family, but the spending isn't equal. This often happens in restaurants or during group outings where the group divides the total bill evenly, regardless of how much each person consumed. While this might seem like a way to avoid awkwardness, it can lead to quietly costly habits that add up over time. If someone orders more than you, they should pay the difference. Being upfront about money can actually strengthen relationships and prevent you from losing track of your budget due to social pressure. 3. Ignoring digital exhaust and reinvested taxes. Many people assume that reinvested dividends or interest are not taxable until you sell the asset. This is a dangerous misunderstanding, especially when it comes to tax-efficient investing. In reality, reinvested dividends are taxable in the year they're paid, even if you never touch the cash. Failing to account for this in your tax planning can lead to IRS penalties and other surprises when tax time comes around. If you're reinvesting dividends from stocks, bonds, or mutual funds, you might owe taxes on those gains, which can come as a shock if you didn't plan for it. One way to avoid this is by keeping track of your taxable distributions. Use tax-efficient accounts like IRAs or 401(k)s where possible, which can defer taxes on investment earnings until retirement. You should also consult with a tax professional to ensure you're not overlooking the potential tax impact of reinvested dividends. Taking a proactive approach will help you avoid these surprise tax bills. 4. Chasing what's working lately. It's tempting to jump on the bandwagon when a particular investment or trend is making headlines. Whether it's AI stocks, cryptocurrency, or the latest market boom, many people chase what's popular without considering whether it fits into their overall strategy. This can lead to buying at the peak when prices are inflated, only to see the investment lose value as the hype dies down. The key to successful investing is to stick to a strategy and avoid following trends without doing proper research. The best investments are those that align with your long-term goals, not the latest hot trend. By focusing on fundamentals and long-term trends, such as consistent cash flow, solid companies, or diversified portfolios, you can avoid short-term market swings and stay on course with your financial strategy. 5. Underestimating the black tax or social obligations. Many financially stable individuals feel compelled to financially support family or friends in times of need. While helping others is important, failing to set clear boundaries can lead to the black tax, a term for the financial obligations that are often imposed by social or familial pressure. The black tax happens when you're constantly asked for help or financial support without clear terms. and it can create a cycle of debt and strain on your personal finances. This is especially common among first-generation wealth builders who feel obligated to share their newfound financial stability with their families or communities. Without clear boundaries, these financial obligations can drain your savings, prevent you from securing your future, and even lead to resentment. To avoid this, it's important to set boundaries with your loved ones. You don't have to say yes to every financial request. Consider your own financial goals and prioritize your own well-being before offering help. If you do want to help, set terms that don't jeopardize your financial future. 6. Static emergency fund thinking. The standard advice is to set aside 3 months' worth of expenses for emergencies. While this may have worked in the past, it's no longer enough to protect you in today's unstable economy. Many financial experts now recommend 6 to 12 months of living expenses for your emergency fund, especially for those who are self-employed or have variable income. An emergency fund is meant to act as a buffer in case of job loss, unexpected medical expenses, or other financial setbacks. However, with the rising cost of living, a 3-month emergency fund might not cover all your necessary expenses in today's world. Review your emergency fund regularly and adjust it to match current living costs. If you're a freelancer or have an income that fluctuates, aim for a larger fund to ensure you're covered during tough times. Keeping an emergency fund that is too small puts you at financial risk, so it's better to overprepare and have peace of mind. 7. Negotiating without data. Negotiation is a powerful skill, whether you're negotiating your salary, freelance rates, or a contract with a vendor. However, many people make the mistake of negotiating based on emotion or gut feeling rather than hard data. Negotiating from a weak position can result in you leaving money on the table, whether it's from a lower salary offer or less favorable terms with a supplier. To negotiate effectively, you need to come prepared with market data. For salary negotiations, know the average pay for your position in your area or industry. If you're negotiating a business deal, ensure you have data to back up your value proposition. Negotiating with facts and evidence puts you in a much stronger position to secure better deals. By doing your research and preparing with data, you'll make informed decisions and get what you truly deserve. 8. The minimum payment comfort trap. The minimum payment trap is one of the most common personal finance mistakes that prevent you from building wealth. Many people make the mistake of paying only the minimum required on credit card balances. While this might feel manageable in the short term, the interest on credit cards is often extremely high, and by only paying the minimum, you're locking yourself into years of debt repayment. Paying off debt should be a priority. If you only make the minimum payment, you'll likely spend years paying off the principal, all while accruing interest on the balance. The key to escaping this trap is to pay more than the minimum. Aggressively tackling high-interest debt with a strategy like the debt snowball or debt avalanche method will help you pay down balances faster and prevent interest from piling up. Focusing on eliminating credit card debt as quickly as possible will allow you to free up money for investing, saving, and building wealth. Remember, the longer you carry high-interest debt, the harder it becomes to accumulate wealth. There you have it. Top 8 personal finance mistakes that cost you money. By avoiding these common mistakes and implementing smarter strategies, you can set yourself up for long-term financial success. From factoring in inflation to eliminating high-interest debt, these actions will help you take control of your financial future. If you found this video helpful, don't forget to like, share, and subscribe for more insights on how to improve your financial habits. Let me know in the comments which mistake you've been guilty of and what steps you're taking to correct it. I'll see you in the next video.